Good evening to all esteemed members and participants, and welcome to all the dignitaries present here. On behalf of the Direct Tax Committee of I warmly welcome you to this webinar on Premier of Income Tax 2025. So now, as we stand at this threshold of a new tax regime, the Income Tax Act 2025, it brings with it a significant structural changes and interpretational challenges. And given that law is still in the early stages of understanding, this session proves to be like both a timely and critical for all the professionals here to build clarity and readiness. So, thank you to the Direct Tax Committee for arranging today's discussion. I am CA Neha Fadke and I will be your moderator for today's session. And it is my honor to welcome our speaker for the day's CA Subodh Shah sir. And it is my honor to now introduce to you our Direct Tax Committee Chairman, CA Chandrasekhar Vasan Chitre sir, who is the member of Central Council member belonging to Pune. He is a senior professional with over 4 decades of experience, and he specializes in direct taxes, legal drafting, and corporate advisory. He has also led key ICI initiatives, including the revised guidance note on tax audit, and made significant contributions to the Code of Ethics amendments, which we saw in the very recent past. Which has been very helpful and beneficial to the practicing and chartered accountants at large. So now I invite the chairman of Direct Tax Committee, CA Chandrasekhar Vasan Chitre, to deliver the welcome address. Sir, over to you.
Yes, sir. It's indeed a pleasure to join for this webinar on the Premier on Income Tax Act 2025. We are indeed fortunate to have an expert speaker in the form of CA Subodh, Subodh Shah, who has experience in the profession, delivering lecture maybe for past 3 decades, and his discourse is much sought after by the audience. So we are really fortunate that he could spare time this afternoon. Neha, who is also a secretary of Pune branch, she was also kind to spare her time and moderate this particular session. I'm sure if the members who are attending this particular webinar, if they have any issues, maybe they can post in chat box and the moderator will take it to the speaker who will address those issues. As far as Direct Tax Committee is concerned, you must have seen that it has published Income Tax Act 2025 and Income Tax Rules 2026, priced at rupees 500 and 700 respectively, and combo price 1,100. Many of you have placed orders also. So today itself, the office had a detailed meeting with the publisher, the printer, and it has been assured that maybe in the coming week, those copies of the Income Tax Act would be delivered to the ICI and onwards to those who have registered their order with the CDS portal. As far as the rules are concerned, rules copies are already available with the institute. So maybe rules and act together, those who have ordered, and maybe act to those who have booked for act will be received in due course of time. As far as this act is concerned, the ball has been set rolling from 1st April 2025. The government, the CBDT, the finance ministry, their contention is that this particular act, as far as substantive changes to Income Tax Act 1961 are concerned, they have not been made. Only language has been changed and it has been much simplified. However, one will appreciate that in case of any tax law, this simplification is a challenge, because maybe any simplification would make the government exchequer compromise some revenue. So in order to plug the loopholes, the changes are made, the amendments are made. So maybe a decade ago, when direct tax code was talked of, at that time, being the chairman of direct tax committee of a chamber of commerce, I had occasion to present before the then constituted group, and there I stated three things. One is generally the amendments, changes, etc., made by the government pursuant to some demand. And here, blissfully, nobody has demanded that the Income Tax Act should be changed. Still, government is doing it. Secondly, as far as the taxpayers are concerned, at that time they were 6 crore, now 8 crore. Out of 6 crore, maybe 5 crore, 50 lakhs or something more. For them, the Income Tax Act only means the provisions relating to salary and provisions relating to house property. And there is limited confusion, and they are happy with the present law. So they don't require any further simplification. But simplification is expected in the by those maybe 50 lakh rupees, and even if it is complicated, I think there are enough number of chartered accountants to guide such persons who are having substantial income from business and other activities. For corporate sector also, they are engaging professionals like chartered accountants, and they are adequately guiding them. So this is second ground that there is no need of simplification. And third, as far as Act is concerned, Act is normally simple. However, the taxpayers with an enthusiasm of saving taxes find out the loopholes and save the tax. And then the taxman thinks that, okay, that was not expected, and plugs the loophole. And I illustrated this with the definition of clause 47 of section 2, transfer. So when you say sell or exchange any capital asset, well, one can understand it is transferred. Maybe you have gold, you have sold, you got 1 crore rupees, there is sell. If you have gold, you exchange it for some equity or residence, whatever, there is sell. But then, subsequent developments, like maybe a lady converted her capital asset into stock in trade and then sold the stock in trade, and only on difference between the consideration and the fair market value of stock in trade on the date of conversion, she paid taxes. And at that time, conversion of capital asset into stock in trade was not considered as transfer. So section 45 did not trigger because there was no transfer. The loophole was plugged. Coming to immovable properties, the sale of immovable properties is complete only when the conveyance is registered in favor of the purchaser. So if an agreement for sale is made, possession is handed over, and maybe for 10 years conveyance is not executed, under Transfer of Properties Act, it is not a sale. And if it is not a sale, there was no incidence to trigger the provisions relating to capital gain. So that was plugged by incorporating that, okay, agreement for sale with possession, like part performance under section 53A of Transfer of Properties Act, that also will be considered as transfer. Then taxpayers did not do any activity relating to agreement for sale. They had a flat or an apartment in a cooperative society. So they sold shares of cooperative society, and by virtue of the shareholding, the buyer of the shares got possession of the property. So shares were sold for a nominal amount because they were of nominal value. Another thing that nothing was done, possession of the property was given, and a power of attorney was executed, enabling the buyer to execute a conveyance and get it transferred. So again, no agreement for sale, only possession was there. So it did not trigger section 53A of Transfer of Properties Act. So again, no tax. So to plug that, another limb was added to clause 47 of section 2. So successive acts of the taxpayers required plugging loopholes, and then it went on complicating. So any efforts in simplifying law where the taxpayer finds out any loophole, I think the taxman will try to plug it, and then the law will become complicated. Today, we are told that okay, number of words are reduced, number of sections are reduced, but the real crux is the rigor of law has to be reduced, not the words and chapters and sections. Let us see in years to come whether it is seamlessly implemented. One good step is about the faceless hearing of maybe assessments, first appeals, maybe in second appeals also, although not faceless, virtual hearings are set into motion. So these things will maybe reduce rigor to some extent, and the assessments, rather than being subjective, will be more objective because they will be based on evidence and submissions. Now, as far as this act is concerned, they have changed certain terminologies, like notwithstanding anything to the contrary, they have said irrespective of. So such changes have been made. So again, we may have to reinvent the wheels because these particular phrases were judicially interpreted. Now again, we will have to interpret irrespective of. Maybe they say it is synonym to what was there in the earlier era. And particularly Income Tax Act 2025, as I was informed, is only presenting Income Tax Act 1961 in a different wordings. Substantive changes are not there. So if you compute income under section provisions of section Income Tax Act 1961, or if you compute under Income Tax Act 2025, the similar results would emerge. The income would be the same amount. And certainly, therefore, in that sense, both provisions are, both acts are synonyms. But then there are certain distance differences also, and people want to understand what are those differences. And therefore, it was thought appropriate that maybe we will have this particular session. So webinars from Direct Tax Committee will continue on each Thursday, 2 hours in the evening. But these will also be supplemented by the training sessions, the workshops on the provisions of Income Tax Act 2025 and rules starting from 1st May. At the moment, the committee is in a process of preparing background material. There, we want some stuff, some written information about a particular section, chapter, then some talking points on it. And then, based on that, PowerPoint presentations would be prepared so that the same knowledge is dispensed throughout the length and breadth of our country. So there won't be a variation in dispensation of knowledge. So right now the committee is in the process of compiling this particular information. If any one of you is interested in joining this process of compilation, maybe drafting of material, say on salary, house property, assessment, whatever, you are welcome. You write to our committee at the email ID DTC, Direct Tax Committee, that is dtc@icai.in. And then we will certainly get in touch with you. Along with the mail, if you also write what is your topic of interest, that would facilitate us earmarking that particular topic for you. And the earlier we generate the material, maybe we can flag off these sessions about training on Income Tax Act 2025 right on 1st day of May 2025. Of course, we have geared up. So by next Thursday, we will have to accomplish all these tasks, including preparation of PPTs. So we are aiming at that. Today only we had meeting. We once again deliberated this action plan, and we are going ahead with that. As far as tax audit guidance note on audit of charitable institutions, that also will be revised in due course of time. And maybe we expect that by May end, both these revised guidelines will be available. So friends, at the moment, we have to take a premiere on Income Tax Act 2025. And Subodh Shah, who is very seasoned speaker, knowledgeable chartered accountant, and under whom number of chartered accountants have been trained. You are very lucky that he would be taking us through this overview of Income Tax Act 2025. So I'm confident that you will be able to understand the nitty-gritties of this particular act, which has now come into place uh, from an eminent expert. Thank you.
Thank you so
Over to
much,
you.
sir, for your insightful address. Uh, we now move on to the technical session, and it's my privilege to introduce C.A. Subodh V. Shah, sir, who is our eminent speaker for the day. He's a practicing chartered accountant with over 3 decades of experience and an exceptional academic record with securing ranks at all CA examinations. And he has also guided and mentored a lot of students, I'm sure, who must have themselves also secured ranks in various chartered account CA exams. And he is also widely respected for his practical insights. One thing which is not written in his profile, I would want to tell you all that he is an avid trekker also. And as I am from the same city, I can tell this about him here. So I am sure with all the energy which is required for delivering a session on something new as an Income Tax Act 2025, uh, I am sure it is going to be a wonderful session, and he will by the end of this session, definitely we will be at least 2 steps ahead from where we are at the beginning in terms of this new act. So thank you, Subodh sir, to agreeing for taking this wonderful session. And over to you, sir.
Thank you, Neha. At the outset, I would like to thank the Direct Tax Committee and its chairman, C.A. Chandrasekhar Chitre, for giving me this opportunity to share my views, my thoughts on the Income Tax Act 2025. Now, Shekhar has already given us the details, the basic idea of what the new Income Tax Act is. Let us directly delve into the topic proper. Now, what we are given to understand is that there is no major policy change in the new Income Tax Act. So let us see what are the principal objectives behind bringing in this new Income Tax Act 2025, which is replacing our old Income Tax Act of 1961. First objective is textual and structural simplification. So the idea is to make the language very simple and easily understandable so that if the wording is precise and clear, it would help in avoiding any litigation. Of course, be as that may be, we chartered accountants and lawyers are very clever enough to, in spite of all of this simplification, find out the variations in the commas, if and but, and find some different interpretation. Time will tell. Second, as I said, there is no major policy implication at all. So whatever were the computations in the earlier law, the method of calculations, the computation of each head of income, tax rates, everything has remained unchanged. The intention was not to actually simplify the calculations or make a fundamental change. The intention was only to simplify the language of the law. So no changes at all as far as your basic calculations are concerned. The another point was to eliminate the intricate language, as Shekhar has rightly said, that many complicated words which probably the government felt were complicated have been removed, like notwithstanding, and that has been replaced by irrespective of. But of course, every simplification gives a rise to different complications because whatever is the law settled by the courts is now unsettled, and using new language could result in slightly different interpretation as compared to what was already being held earlier. Then yes, one very good aspect has been to remove the redundant and repetitive provisions. Many times in certain chapters, you find some provisions are completely redundant. Part of your chapter 6A, you find there are so many provisions which are uh, not applicable for more than the last 2 decades, but they are still existing on the face of the statute. They have been removed, and so also at so many other places. Many sections have been reorganized logically. The grouping is much more logical. The sequencing is much more logical. There is a lot of tabular approach towards the new Income Tax Act compared to what we had earlier. The intention is to make the law much more easily readable as compared to earlier. And the best idea of this is when we go to the TDS provisions, we find entire TDS provision has been reorganized into different tables so that at one glance, going through the table, you can find the entire provisions relating to TDS, and it is so easy to read, so easy to identify what is the rate of TDS or what is the exemption, etc. It's very, very easy to understand now. Now, going to the statistical aspect, as Shekhar has already pointed out, that yes, there is a reduction in the size of the act, that almost by 50%. From more than 5 lakh words, the number of words has gone down to 2.5 lakh. But what I really would like to highlight is this aspect that as far as tables are concerned, there were 18 tables in the earlier law. In the new Income Tax Act, there are as many as 57 tables. Now, that is a huge jump. And the intention is wherever things are complicated or you need simplicity, they have put the data into tables. Similarly, many formulae have been introduced. Earlier, we had 6 formulae in the old Income Tax Act. Now we have as many as 46 formulae in the new Income Tax Act. And the logic is, it's not that these formulae are new or formulae are different. The point is they were earlier expressed in English, in the sense that they were not written in a mathematical style, they were written in a English grammar style, which again used to cause a problem because you can understand interpretation issues can arise. So now you have a simple formula that A is equal to B minus C upon D or something like that. That makes life very simple. You cannot have two views on how to interpret, how to read a particular formula. Similarly, just like we had schedules in the old Income Tax Act, we have schedules in the new Income Tax Act, but with a huge difference. As far as most of the chartered accountants who are working are concerned, very, very rarely have you ever used the income tax schedules. However, once we see what is the content of the new schedules to the income tax 2025, you will realize that in this new act, we will be reading the income tax schedules probably every single day. To that extent, these schedules have now become important, which once upon a time were, just something which most of us never even read in our entire lifetime. So anyway, now the real question is, how do I approach this income tax act? Because no doubt the government has intended to make it quite simple. There is what I will say, huge effort done by them, and that too in a very short span of time. A lot of good working has been done from their side. But now, as a chartered accountant who has read the Income Tax Act 1961, how do I approach it? That is where the confusion is arising. That what is the approach to be followed? And I thought that, okay, let us approach it in a different way. Instead of, going through every single provision, today, what I am trying to do is I will go through the structure of the act and I will then go through the various provisions where there are changes. So wherever there are some changes in the wordings of the old act compared to the new, which have a different interpretation or something extra has been covered up, maybe a old loophole which was there has been now taken up. These are the issues which we shall discuss so that, we know, okay, these are the points of differences. So once we identify the points of differences, it will be easy for us to understand, because wherever there are no changes, subject to the simplification of wording, everything remains the same. So quickly, first, let us go through the structure of the act as such. First chapter, you have the preliminary chapter, which has sections 1, 2, 3, which deal with the basic provisions like the definitions, the applicability of the act, and the concept of the tax year. Then you have the basis of charge, which existing we had right from section 4 up to section 9. Now it is going to go from sections 4 to 10. And friends, at this stage, I do not think we should focus on the section numbers, because section numbers are something which we will get used to over a period of time. For those of us who have been in this profession for a longer period of time, it is going to take us much more longer to switch over to the new section numbers. But for everybody, I think for the next 2 or 3 years, we will have to continuously cross verify, okay, what is the old provision section number and what is the new provision section number, because that will help us to correlate. But that will particularly be very useful, required when we are going to fill up any of the forms relating to income tax. Then we have chapter 3. So your chapter 2, basis of charge, which will cover your residential status. It will cover the basic charging provision of the act. It will cover the incomes deemed to accrue or arise in India. All those provisions are covered here. Chapter 3, the incomes which do not form part of total income. Basically, these are the exempt income. And you will see these are covered in section 11 and 12. Chapter 4, computation of the total income, going right from section 13 to 95. Same 5 heads have been retained, no difference. Salary, house property, business profession, capital gains, income from other sources. Chapter 5 will deal with the clubbing provisions, that is the income of other persons included in total income of the SAC. So our earlier provisions of section 60 to 64, they are now covered here in chapter 5. Chapter 6 will deal with the aggregation of income. 7 will deal with the set off and carry forward of losses. So our earlier chapter 6 is now chapter 7 out here, set off and carry forward of losses. Chapter 8 will be the deductions from our total income. So which was our earlier chapter 6A is now chapter 8, which is divided into different parts. Part A, the general provisions. Part B, the deductions for certain payments. Part C, deductions for certain incomes. Part D, deductions for certain other incomes. And Part E, other deductions. So right from section 122 to 154, we shall be having the old chapter 6A or the new chapter number 8. Chapter number 9, the part A will deal with the rebates. Part B will deal with the double taxation relief. So we are aware currently we are using section 90, 91, 90A for the double taxation relief, where we take recourse to the tax treaty which India has with the other countries to get some benefit. So those provisions are covered out here. The various rebates, whether it is 87A or 89A or 89, all these will be covered out here. Chapter 10, the special provisions relating to tax avoidance, that is nothing but our transfer pricing provisions. They are covered out here from section 161 to 177. Chapter 11, the general anti-avoidance rules, that is what we popularly call as the GAR provisions. They are covered here. The chapter 12 deals with the mode of payment in certain cases. You know, our old sections 269 SS, 269 ST, 269 T, where we are prohibited from accepting the loans, deposits, or repayment of loans, deposits, or any of 20,000 or more, or the amount of cash of 2 lakh and above. All those are now regrouped out here in chapter 12. Chapter 13, the determination of tax in special cases. So the tax rates as applicable in the various special cases. A, the special certain cases are covered. B, capital gains. C, new tax regime. D, the provisions relating to MAT and the alternate minimum tax. E, the non-residents and the foreign companies, their tax rates. F, provisions relating to pass-through entities, and G, the special taxation regime for the shipping companies. Now, what you will see here, the grouping has been done so nicely that at one place you will, if you see this part E, special provisions of tax relating to non-resident and foreign companies. So if my SAC is a non-resident or a foreign company, then all the provisions relating to the tax rates of these entities are now covered directly in sections 207 to 220. So all grouped together at a single place. Provisions relating to our pass-through entities like the venture capital funds, venture capital undertakings, or your REITs, InvITs. Again, those provisions are grouped together at one location. Chapter 14, deals with tax administration. Tax administration, the part A, authorities, jurisdictions, functions, and part B, the powers, the various powers. So we are talking in this tax administration, the various provisions right from section 116 right up to section 138, the old sections. Chapter 15, return of income. Return of income, first of all, the part A is relating to PAN, which is section 262. And part B is filing of return and the processing, section 263 to 267. Now, very interestingly, we are used to filing the return of income so far, and always we know the section is 139. Now we know the section is for filing the return is section 263. And for anybody who has been in tax practice for any period of time, we know the moment we hear section 263, what comes to our mind? Okay, this is bad news, because it is always a notice from the income tax that, okay, we are going to revise your assessment, which has happened apparently because there is some escapement of income, or say there is some underassessment of your income, etc. But now section 263 hereafter will be entirely relating to filing of return. And very interestingly, this section 263 is almost identical in the sequence as far as our existing filing of return is concerned. We have our existing regular returns filed under 139(1). Here we have again 263(1), filing of the regular returns of income. Returns of loss, section 139(3). Here you have section 263(3). The returns relating to the revised the belated returns 139(4). Here we have 263(4). The revised returns 139(5). Here we have 263(5). So it's almost, you can say, in the similar sequence what is there in our existing section 139. Then chapter 16 deals with the various assessment procedures which go excuse me, right from section 100, old section 140, right up to the section 158. So part A will cover the assessment, which will be our assessment, best judgment assessment, reassessment, rectification of errors, all that will get covered. And part B, we have the special provision for search case assessment. So search assessments which are covered currently under the block assessment, so that those provisions are covered separately from section 292 to 301. Chapter 17 deals with the special provisions relating to certain persons. So we have the special provisions relating to the AOPs, partnership firms, HOFs, and very importantly, and which is a major change, including, I will say, not only locational change, but a policy change, and that is the special provisions for registered non-profit organizations. Now, as far as the non-profit organizations are concerned, these are nothing but what we earlier used to refer to as public charitable trusts or religious trusts. They are now getting covered here under the non-profit organizations. So, if you remember the earlier provisions relating to charitable trusts, or these trusts which were enjoying the tax exemptions, were earlier covered either under section 1023C or under section 11, 12, 13. All these provisions were applicable, and they were covered under the chapter 3, which was incomes which are exempt from tax. Now you can see the entire scheme of taxing trusts has now been shifted to a special tax regime. So you now have an entire standalone chapter dealing with non-profit organizations. So we are not now any longer saying that, okay, income of a trust will be by default exempt subject to conditions. It is taxable but eligible for deduction subject to certain conditions. And the word trust is no longer used. Everywhere they are using the word non-profit organization. So this is the new terminology which has been created instead of the charitable and religious trusts. Then we have chapter 18 dealing with resolutions. The part A, appeals, B, special provisions for avoiding the repetitive appeals, what we have section 158A, 158AA currently. Chapter 18, which is part C, is the revision by CIT. Part D, So this revision by CIT is nothing but our old section 263, old section 264, which are now coming to 377, 378. Part D will be the alternate dispute resolutions. Then very important, we have the chapter 19, collection and recovery of tax. In the collection and recovery of tax, we have part A, the general provisions, deduction and collection of tax at source. And here is where there is a huge change, because entire provisions of TDS are now covered in one single section 393. All provisions of TCS are covered in 394. You don't have the entire family of 194 going right up to that A, B, C, D, right up to now alphabet T, which is there in force. You simply have two simple sections, and in each of the sections there are multiple tables which give you the entire idea about when, where, and how, what is the amount of TDS or TCS. We shall see this a little bit in detail later on. Part C of this chapter is relating to advance payment of tax. Part D, collection and recovery. E, interest chargeable in certain cases. And F, levy of fees. So currently we have this particular chapter of levy of fees getting expanded every year, and particularly in the Finance Act 2026, there has been a substantial change in the concept of levy of fees, as we shall see. Chapter 20 deals with refunds, 21 penalties, 22 offenses and prosecution, and 23 the miscellaneous chapters going right from 499 to 536. Okay, this is okay as far as the provisions are concerned. Fine, principally the chapters are more or less similar, subject to a few minor changes in the positioning. But more important is, in my opinion, the schedules. The schedules is something which we really have to focus on. As I said, we have now multiple schedules, that is as many as 16 schedules. Now what are the contents of these schedules? Now the purpose of these schedules is multiple fold. One is those provisions which are not applicable to general public, which are used only by a few set of people. Those provisions have been shifted to schedules. Another type of classification is where the main sections have become very voluminous, complicated to read, and they would like you to understand it in a tabular format. Some of those provisions have been moved to the schedules. Let us see. Schedule 1 is relating to conditions for certain activities not to constitute business connection in India. Now we are aware we have these foreign investment funds, and there are issues that whether they are resident in India or non-resident in India. Currently, we have the provisions of Section 9A, which gave a whole series of, few pages of criteria to decide whether they are to be treated as a resident or non-resident. But then question is, how many people actually need it? So realizing that, this is a provision which very few taxpayers actually require, maybe a few hundred people across India would require, then they have said, let us shift it from the main act to a schedule. So then if I am a fund manager, if I am an investment fund, then I can go to schedule 1. Other taxpayers in the country need not read this provision at all. More importantly is schedule 2 to schedule 7. Schedule 2 to 7 is nothing but old section 10. Old section 10 was the list of various incomes which are exempt from tax. And there under section 10, we had various exemptions going right from section 10.1 to 1050 plus. And within that, you have alphabets also, A, B, C, D, whatnot, different alphabets also we are having. So the reading of the exemptions had become very, very complicated. Plus, these exemptions were all mixed up. There was no logical grouping of those exemptions. So then finding a particular exemption would be quite a complex task. Now, what the new Income Tax Act has done, they have done something really fabulous and something which is going to make our life as a person interpreting the law very simple. And they have divided that entire section 10 into different schedules. all the exemptions which are there, which are given in the original section 10, have now been grouped into 6 different schedules, schedule 2 to schedule 7. So from the title of that schedule, you will be immediately able to identify, okay, whether a particular income is going to be covered under this schedule or in another schedule. Let us see. First schedule we are dealing with is schedule 2. Incomes not to be included in the total income of everyone. Now we are saying everyone. Means whosoever is the assessee, you may be individual, HUF, company, partnership, LLP, whoever you are, this type of income will be exempt for everybody. And one of the best and simplest examples is your old section 10(1) agricultural income. So whether I'm a company or whether I'm an individual, agricultural income is exempt. Now, all those incomes which are exempt for everybody are mentioned in Schedule 2. The entire list is given in Schedule 2. Schedule 3, incomes not to be included in the total income of eligible persons. So these are exemptions which are available only to certain eligible persons. So if you satisfy the conditions of being an eligible person, then you are entitled to these exemptions. Schedule 4 contains incomes not to be included in total income of eligible non-residents, foreign companies, and such other persons. Now, this is a very, very, I will say, beautiful grouping. A very common issue which I realize in real practice we have faced is that when we are dealing with non-residents, there are quite a few exemptions which were available. Similar exemptions are continuing now also. But the problem was those exemptions were scattered across the section 10. Now, as a taxpayer, as a chartered accountant, if I want to know, okay, which are all the exemptions available for a non-resident or for a foreign company, all that I need to do is read Schedule 4 and that's it. Everything, any and every possible exemption relating to them is available at one place. And there is no doubt in my mind that, okay, have I forgotten, have I omitted, have I overlooked a particular exemption? That doubt will no longer remain. Schedule 5, income not to be included in the total income of certain eligible persons, including investment funds, business trusts, and their unit holders. We are aware that certain investment funds, the business trusts like the REITs, InvITs, and their unit holders, they enjoy a pass-through status. Certain incomes are exempt for the fund or the trust. Certain incomes are exempt for the unit holders. So all the exemptions relating to the funds, the trusts, and the unit holders are now regrouped into into Schedule 5. Schedule 6 is income not to be included in total income of persons located in IFSC, the International Financial Services Center. Basically, we are talking of the gift city or having income therefrom. So any and every exemption relating to the gift city is grouped now in Schedule 6. And Schedule 7 deals with persons who are exempt from tax. So here we are talking of list of persons. So if you are this person, your income is whatever be the source, it is completely exempt. For example, income of the Employees Provident Fund Organization, exempt. Or income of Reserve Bank of India, exempt. So if you are this type of a person, your income by default is exempt. So you can see that reading section 10 at one go and now reading all the exemptions grouped into 6 different schedules, and that too in a simpler format, is going to be a game changer. And this is going to make the understanding and the applicability of the exemptions very, very simple for we chartered accountants. Schedule 8, income not to be included in the case of political parties and electoral trusts. So for the political parties and electoral trusts, their exempt incomes are covered here in Schedule 8. Schedule 9, the deduction for tea, coffee, rubber development account. Now these entities who are growing and manufacturing the tea, coffee, rubber, all these plantation entities, they are enjoying certain special deductions under Section 33AB. Now, these deductions are there only for these plantation entities. So instead of keeping them in the main business profession chapter, all the conditions relating to the deduction and the details are now given in the Schedule 9 since they are applicable only to limited type of persons. Same way you have Schedule 10 deduction for the site restoration fund, which is nothing but the old Section 33 ABA that is now shifted to Schedule, that is Schedule number 10. Intention again, all the conditions, criteria, and what all is to be done to claim that deduction is mentioned now by way of a schedule. Again, applicable only to the mining and the exploration companies. Schedule 11, the treatment of the recognized provident funds, approved gratuity funds, superannuation funds, and the power to make rules. We had a similar schedule earlier also. Schedule 12, minerals, that is the list of minerals is mentioned for the purpose of claiming the special deduction we have. I think it is under the old section 35E for claiming the amortization cost of prospecting for the minerals. Again, applicable only to the mining companies. So kept in a schedule 12. Schedule 13, list of articles or things. Now, under section 35, if I am a corporate entity and I'm doing the manufacturing of certain items, I'm eligible for 100% deduction for scientific research. Now, what happens is this deduction was allowed provided I manufacture anything other than what is given in the negative list. That negative list is given in Schedule 3. Schedule 14 deals with the insurance business. We are aware that right from inception, the insurance business computation of income has been governed separately. So A, life insurance computation, and B, other insurance business. Then you have Schedule 15, very interestingly, which is nothing but our old Section 80C. So the entire list of deductions, the payments which we were making under Section 80C, whether it was life insurance or provident fund or national savings certificates, all those payments, Sukanya Samruddhi scheme, all they are now mentioned in Schedule 15. Probably it seems that government is of the thought process that, okay, majority of the taxpayers are now going for the new tax regime and the old tax regime is meaningful for hardly less than 1% of the taxpayers. So let us move all these deductions instead of the main act directly to a schedule. And then, of course, you have Schedule 16, which is the permitted modes of investments or deposits by the charitable or religious trust. Under the existing Section 11, there is a provision which mentions that every charitable religious trust has to invest its funds in the prescribed manner. And a huge list of types of investments is mentioned. That is now put into a schedule. So overall, we can say that yes, what the government has intended to do, and it has done quite successfully, and that is they have simplified the act. Definitely, they have made the law much more easily readable. But of course, the problem will remain that there are going to be interpretational issues because there are going to be some bright minds who will put their brain together and come up with some unique ways of reading the new act also. In spite of the intended simplification, there could be in some cases some complications. But with that, let us now go to the definitions, and I will say topic wise we will go to the major changes which could have an impact, or at least which we should be generally aware of in the new Income Tax Act 2025 as compared to the old Income Tax Act 1961. Probably the most important and significant change is the concept of the assessment year and previous year. Assessment year, previous year, two concepts which have troubled the taxpayer, because what we understand, we know that as a chartered accountant, we are very clear. Previous year is the year in which we earned the income. Assessment year is the year after that in which the income is computed and taxed. So previous year is 24-25, assessment year is 25-26. But we know the client gets thoroughly confused, the accountant of the client gets thoroughly confused, and we land up with a lot of, practical duplication of work. Because you get a typical call from the client, sir, वो 25-26 का balance sheet चाहिए. And then 25-26 means he wants financial year 25-26. You think of assessment year 25-26, and then the data is sent, and then he calls you, sir, you sent the wrong data, we needed the other year. which I think every single chartered accountant in the country has faced this common issue. Because you can't blame the layman for not understanding assessment year and previous year clearly. So to do away with this complication, something really fantastic has been done in this act, and that is putting an end to assessment year, putting an end to previous year. Now hereafter, we shall have only 1 year tax year. So the financial year 26-27 will be the first tax year, that is tax year 26-27. So hereafter, when the taxpayer will say, I want the uh, let us say ITR for tax year 28-29, he means financial year 28-29. We also understand 28-29, and it is only 28-29 and nothing else. There cannot be two ways of reading this at all. But of course, this will create a very interesting and a funny situation in the transition year. Now, currently, this year, that is financial year 25-26 is just over, which is whose returns will be filed in July, September, October, November. Now, the interesting part, financial year 25-26, we will be filing the ITRs for AY 26-27. Current financial year 26-27, we will file the ITRs next year for tax year also 26-27. Now that will create a very interesting confusion when the client says, okay, sir, I want to send the ITRs and the financials to my banker for my loan renewal or whatever purpose for 3 years. And you will send AY 25-26, you will send AY 26-27, and you will send TY 26-27. And then you can really expect very funny questions coming up from the other side. Oh, if the banker is not well read or well informed, he could tell your client, अरे आपके CA ने 2 balance sheet दे दी एक ही साल के 26-27, he has given 2 different ITRs. How is that possible? No, this is a practical challenge we'll have to ensure, and I am sure that ICI will have to probably send a circular or some sort of a guidance which could help the bankers to understand the concept of the tax year, and particularly in the first tax year, which is going to be 26-27. Now coming to some other definitions where there are minor changes. Assessment under section 2, subsection 13. It now says that assessment includes reassessment and recomputation. Now the old definition in the earlier act said assessment includes reassessment, full stop. The doubt was always there whether a recomputation, is it an assessment or is it not an assessment? That doubt was there. Now that ambiguity is gone, that reassessment, the recomputation is also a part of assessment. Assistant director. Now, the earlier law stated assistant commissioner includes deputy commissioner, but it did not state that assistant director will also include deputy director. But now they have clarified in the new law that assistant director will also include assistant director of income tax as well as deputy director of income tax. Now, one good change and of course a major change is with respect to books of accounts. We have seen, since we are following the tax law for so many years, that okay, originally books were always in written form, then the electronic or digital form and printouts thereof came up. Now the problem is, okay, originally they accepted books of accounts physical, then they said, okay, which are printouts of whatever you store on your computer. Then they said, okay, even if it is now stored on your hard disk, it is fine. But now the problem is your accounts are no longer stored on your own hard drive. They are not on your computer, they are stored in the cloud. So whether the books of accounts stored in the cloud would be eligible to be called as official books of accounts, and they have expanded to definition to clearly state that, okay, the books stored in electronic or any digital form or on cloud-based storage. So they have expanded the type of technologies to ensure that even the new technologies which are being used are going to be covered, are going to be valid for deciding what are books of accounts. Some of the definitions where there are no changes, they are there. Let me just skip this. Now coming to a very funny situation. It's a small point, it really doesn't affect us today, but very interesting. The charging section, section 4. Many times, there is a loophole in the old law. You realize only after the new law has come and the old law has gone that, okay, the old law had a loophole, which is now being covered up. In the old section 4, they said that, okay, the government through the income tax 1961 could do TDS, could do advance tax. TCS was not there. The power to enforce or levy TCS was not there. And thankfully, they realized this omission at the time of redrafting the new law. And they have now said that, okay, the charging section saying that, okay, government can levy income tax, TDS and TCS. So TCS, which, if I may say so, technically did not have any authority of law, now has a proper authority of law. Then significant economic presence is a minor qualitative difference under the section 9, which deals with the incomes deemed to accrue or arise in India. The significant economic presence, or SEP, we say. Now, it said that if there is a SEP in India, that is, if the non-resident has a significant economic presence in India, then income as attributable to operations carried out in India shall be deemed to accrue or deemed to arise in India. Fair enough. Only now the wording has been changed slightly from saying that income as attributable to operations in India, it is now income which is reasonably attributable. Now, I would say this makes the section a little bit more liberal, a little bit more practical. And let us say, I will say the language is a bit softer as compared to earlier. Then royalty. In the case of royalty, under section 9(6), earlier it was section 9(1) Roman 6, the definition of royalty has been tweaked. The earlier definition of royalties said royalty includes the transfer of all or any rights, including granting of a license. Now the new wording is royalty includes transfer or grant of all or any rights. Now here, the intention is very clear to nullify the Supreme Court judgment in the case of Engineering Analysis Center of Excellence. Now here what has happened is, in the Engineering Analysis Center of Excellence, in that judgment, the important point on the principles on which the Supreme Court had given the benefit, saying that, okay, payment for this software will not amount to payment for royalty, was that, okay, what you are paying for is for use of a copyrighted product, and it is not actually a transfer of the rights in that particular product. And therefore, the taxpayer had got a favorable decision saying that, okay, this is not royalty. Now, by modifying the words transfer or grant, their intention is to overrule the judgment of engineering analysis. However, as far as the payments to non-residents are concerned on account of software, etc., this modification in principle will really not make a major impact at all, because even now the payments to non-residents will be subject to DTAA. And the DTAA will obviously prevail over the domestic law. And in none of the DTAs, this expanded definition of royalty has been so far used. As far as the DTAAs are concerned, a few points. If the terms are defined, are used in the DTA, but not defined in the DTA, but they are defined in the Income Tax Act, then earlier, the law said you will have the same meaning as in the Income Tax Act. New law also says the same. Secondly, if a term is used in DTA, not defined in the Act, not defined in the DTA, but defined in a notification, then the old as well as the new law say, fine, meaning given in notification shall prevail. But at one place, the DTA or there was a gap, and that is there is a term used in a DTA, not defined in DTA, not defined in the Act, not defined in the notification. What to do? Now, that was a gray area. So, in old Act was silent on this. The new Act says, okay, you can adopt the same meaning as is assigned to it under any central law related to taxes, or if in any other case, if it is not defined in a central law relating to taxes, then in any other central law. The intention here is that, okay, this gray area should no longer remain gray area. Some concrete definition would be now available for the taxpayer as well as for the authorities to use. Going to the heads of income, the first change which I would like to highlight, minor change of course, and that is a deletion of the deduction for entertainment allowance for government employees. Of course, we are aware the deduction was only for government employees, and now the income tax authorities have realized that this deduction practically nobody is claiming, and it was again maximum of 5,000 rupees which could be claimed. That deduction is now deleted. A point to be noted, very interesting and very major change as far as presentation of income is concerned. Profits in lieu of salary in the old Income Tax Act excluded these 7 items: gratuity, commutation of pension, retrenchment compensation, amount received from PPF, RPF, etc. All these 7 items were excluded. Income Tax Act, however, the 2025 Act says gratuity will be part of salary. Commutation of pension will also be included in the profits in lieu of salary. Retrenchment compensation is also included in the profits in lieu of salary. So, gratuity earlier was exempt under Section 1010. Commuted pension was exempt under Section 1010A. Retrenchment compensation was exempt under Section 10B. Now we are saying all these 3 are included. So earlier what used to happen, since they were exempted, what we would do in the inner column, we would show, okay, this is the retirement or death gratuity received, less exempt under 1010, and outer figure column, whatever is the taxable portion, if any, would be remaining. Else, if entire exemption was there, then outer column would be 0. So this gratuity which was exempt never became a part of the gross salary. However, the exemption under 1010, 1010A, 1010B have now been deleted from your chapter 3. Now the structure has changed that, okay, if my taxpayer has received death cum retirement gratuity or commuted pension or retrenchment compensation, it will be shown as a part of gross salary. It will be included in the gross salary, and you will be entitled to not an exemption but a deduction under the head income from salary. The deduction is the same as what we were earlier calculating under 1010 or 1010A or 1010B. But it is now a deduction from the salary and not an exemption from income. So the difference will be the final taxable salary will be same in old act, in new act. Presentation difference, the gross salary will be substantially higher in the new act, though the net salary after deductions will remain the same. Why I'm highlighting this is because when we fill up the ITR or we do the computation, if we land up showing the incorrect numbers, then you could have a major problem, and you could have some unnecessary notices from the tax authority saying that, okay, you have not included certain incomes in your taxable income, right? So this is, as I said, a presentation difference. Calculations remain the same. Then coming to business profession, the charging section, old section 28. Under the section 28, we had this 28 3A to 3A, B, C, D, E. All the 5 different types of export incentives were notified, and the section said that, okay, all these export incentives are a part of our business income. But now over the years, government comes up with new export incentives, old schemes go down, new names are given, new export incentives are introduced. So the act, to remain dynamic, what the Income Tax Act 25 has done, they have simply mentioned any other export incentives. So the logic is all export incentives, whether notified today or after 2 years, they will always be a part of business income. Government will not have to modify the Income Tax Act each time a new export incentive is introduced. Then the new section 28, which is there, is relating to deductions. And these deductions are relating to our business assets. Earlier, the business assets enjoyed deductions under three sections. Section 30, rent rates repairs for building. 31, dealt with repairs insurance of other business assets. 38, assets not fully used for business, we were entitled to a proportionate deduction. Now, all these three sections have been merged into one single section, that is namely section 28 of the Income Tax Act 25. So for understanding any deduction relating to business assets, I don't read three sections, I read a single section, namely section 28. Then the research related deductions. Today we have section 35, 35, 2AA, 2AB. In the main section itself, the deduction was given as well as all the procedural aspects relating to the deduction were mentioned. The Income Tax Act 25, to simplify this, they have only mentioned the deduction and the procedural part about how to get the registration, how to get the approval, what are the annual requirements or compliances to be done. They said that this will be left to CBDT, who will frame the rules for the procedure. So the procedural rules are not merged in the act to ensure that rules can be changed at any time. Employee related payments. Earlier act, the employee related payments were spread out across multiple provisions, whether it was 36(1), 5, 5A, sorry, not 5A, 4A, 40A7, 40A9, they are all consolidated into one single section 29. So whether it was employer's contribution to Provident Fund or employer's contribution to the gratuity or employer's contribution to NPS or the disallowance for contribution to unapproved funds or provision for gratuity, all these provisions were spread out over 5-6 different sections. They have all been merged into a common single section, that is 29. So any deduction relating to employee expenses is now directly covered at one location, that is namely section 29. So you can see, this is a very classic example of how they have managed to simplify the law. Then a very interesting point is relating to section 35C. In section 35C, we are basically talking of the old section 48(3), which was relating to salary paid outside India or to non-resident. Now, the section said that if both the conditions were satisfied, that is, tax has not been paid and not been deducted on the salary paid outside India or salary to non-resident, then the 100% salary was to be disallowed, and it was a permanent disallowance. Even today, it is a permanent disallowance. But what is the change? The problem was earlier they said tax was not deducted and tax was not paid. So if I had deducted but not paid, or I have paid but not deducted, in both cases I could claim the deduction. Now they say if tax is not deducted or after deduction not paid, the disallowance will kick in. So the provision has become stricter. It has become very strict. The loophole which was there in the old law has now been plugged. Actual cost of the assets, the old section 43(1), which is now section 39, they have specifically clarified that if while buying the asset, acquiring the asset, you have paid GST and you have claimed ITC on that GST, then such GST will not be part of the actual cost. Existing law only had provision for the excise duty, etc., to be excluded. But after the GST came into the picture, this point was missing from the Act. This has now been included. Another point relating to the tax again, and that is Section 40A Roman 2. Now, 40A Roman 2 of the old Act, what it said, that okay, any income tax. Now, today we are aware that today while we are computing income, if there is any income tax paid, payable, provision debited to your P&L, we always disallow it. We know that this is disallowable under Section 40. But even though it is disallowable, let us compare the wordings. The old law specified profits and gains of any business or profession. Any tax levied on profits or gains of any business or profession or is assessed as on the basis of profits and gains is not allowed as a deduction. Now, this gives lead to an interpretation that, okay, I have business income 50 lakh and I have other income 2 crores. My total income is 2.5 crore, which means that, okay, I compute the income on my tax on business income separately, on other income separately, in the sense proportionately, and I will disallow only the income tax relating to business profession. That was a very interesting interpretation taken, and this matter was being litigated. Now they have officially clarified that, okay, whether it is no longer going to be tax on business profession, it is income tax paid, that is tax paid on income shall be disallowed. So no more ambiguity. Whatever loophole was there, whatever I will say, I will not even call it a loophole, whatever incorrect wording was there has now been rectified. With respect to maintenance of books of accounts, Section 44AA, that is new Section 62, the specified professions of information technology and company secretary are now included in the main section, which were earlier covered through a notification. Similarly, film artists, authorized representatives have not yet been covered in the main act. We assume they will also be covered by the notification only and not in the main act. Presumptive taxation, one very interesting point. Earlier, we had Section 44 AD, ADA, AE, presumptive taxation of the residents. All of these have been merged into one common section, Section 58. Earlier Act said that notwithstanding any provisions of the Section 28 to 43, sorry, Section 30 to 43A. So the old Act for these three presumptive sections bypass the deductions, allowances, disallowances from Section 30 to 43. To 43C. Now they are covering all the sections, meaning 43CA will no longer apply in presumptive taxation scheme. What is 43CA? 43CA is for the real estate developers, that if I sell the real estate for less than stamp duty value, then stamp duty value will be deemed to be the full value of consideration for computing business income. Now here, this, I will say, unnecessary loophole has been created. I think it is unintentional. They have never intended to do this, but it has got created for no reason at all. And this could be exploited. So take a scenario that I am a builder, very small builder. My actual sales this year are 1.5 crores. But if I use the stamp duty valuation, it is 1.8 crores. Question would be, since 43CA is no longer applicable, now whether I will be able to take the base of only 1 crore 50 lakh instead of taking the base of 1 crore 80 lakh. So this is the loophole which possibly unintentionally has got created. Okay. Then for the presumptive taxation with respect to the non-residents, 44B, the sections 28 to 43A did not apply. Now even 43B, 43CA also will no longer apply to this non-residents taxation under 44B. Now, let me focus a couple of minutes on this particular point, because this is something very interesting. and it is going to change a little bit of the way we were handling capital gains earlier. Now, with respect to capital gains, I'm talking of three specific exemptions: Section 54, 54EC, and 54F. Now, an issue which always used to arise was whenever I am selling a depreciable asset, old Section 50 would come into the picture. And the old Section 50 said that even though your asset is a long term, since you have claimed depreciation, compute the capital gain as per Section 50. Section 50 further in place said that, okay, the gain shall be deemed to be short term. Gain shall be deemed to be short term. Now, that was very clearly mentioned. A doubt would arise that, okay, let us say I am an individual. I have purchased a building. It is a residential building, and I have claimed depreciation on the same. Maybe I have used it for my business purpose. Maybe my manager or somebody is staying in that flat and I have claimed depreciation. Today, I sell that flat. Automatically, whatever is the capital gain is deemed to be short term. Sale value minus WDV deemed to be short term capital gain. But the issue would arise, can I buy another house and claim the exemption under Section 54? Or for example, there is an office. I have claimed depreciation on an office or a shop. And today, after depreciation, the value is negligible. I sell it and I buy a house. Could I claim 54F? Or could I invest in the government bonds under 54EC and claim the exemption? Now, let us see the change in the wordings. Now, earlier, what used to be there is the original wording of 54 and 54EC was wherever there is capital gain arising from the transfer of long-term capital asset, the assessee can acquire residential house property or buy the bonds within such and such a time and claim the exemption. The issue was whether we could claim the exemption. This matter was debated by the Mumbai High Court, further going up to Supreme Court in Ace Builders case. And the argument from the taxpayer was the Act says under Section 54, the capital gain should be from transfer of a long-term capital asset. Whether it is 54 or 54EC or 54F, the gain should be from transfer of long-term capital asset. Section 50 creates a deeming fiction that even if your asset is long-term, gain is deemed to be short-term. Gain is short-term. But Section 50 does not create a deeming fiction saying asset is deemed to be short-term. So following this, the argument was made in the court and the assessee have successfully claimed the benefit of the exemption, even on depreciable assets. Okay. And as I said, this principle was upheld right up to Supreme Court level. Now to overrule this, in old section 54 and 54EC, which are the new sections 82 and 85, they have amended the law. And they have changed the wording. Wherever there is a capital gain, wherever there is a long-term capital gain arising from transfer of blah, 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 where residential house property or land or building or both. Now the wording is this, there is a long-term capital gain. Now problem is in a depreciable asset. If I sell a depreciable asset, by deeming provisions, the gain is deemed to be short-term. So I am directly barred from claiming Section 54 or 54EC exemption. So directly overruling Ace Builders case. But very surprisingly and happily for the taxpayer, they did not amend 54F, that is Section 86. The wording of old 54F, the new Section 86 remains intact. Capital gains arising from the transfer of any long-term capital asset. So if I sell an office today, after claiming depreciation and that asset is long-term, can I buy a residential house and claim Section 54F exemption? The answer would be yes. I can do the same. So, and to be very honest, ACE Builder's principle was more common in 54F rather than in 54. And it's very surprising that they amended the 54 and 54 EC, but they forgot to amend 54F. I don't know. I thought maybe it was an oversight. Maybe in the Finance Act 26, they would cover it up, but it seems they have not covered it up. It seems that this is done intentionally. They have left it as it is. Probably they want the assessee to get the benefit. Then with respect to the taxation, with respect to the gifts, very good clarification has come that, okay, earlier we had the lineal ascendant, descendant. The doubt was only paternal or maternal. Now they say both paternal as well as maternal, lineal ascendant or descendant will be covered in the definition of relatives. I'm just skipping a few of the provisions which I feel, are not more, I will say, having impact on our work. That is why I just skipped those 2-3 slides. Okay, because my intention is to cover the other important points which are more interesting. Now, with respect to the assessment procedures, as I discussed, the ITR will be filed under Section 263 of the New Income Tax Act. And a doubt was raised that, somewhere there were some discussions that, okay, if I file my return late under the New Income Tax Act, I will not be entitled to a refund. There was a scare which was created, probably due to maybe not reading the law properly. But let us see Section 433. Section 433 says that every claim of refund shall be made by filing a return as per Section 263. Now, if I file my return under Section 263, they have not said 263(1), because 263 covers normal return, belated return, revised return. So whether it is my normal or belated or revised return, I will still be able to claim the refund without any issue. Another interesting and a welcome change is with respect to updated return. The updated return earlier had some restrictions, and today also they have restrictions where there is some change. If in some cases you cannot file an updated return, and one of those was if assessing officer has information in respect of such person for the relevant AY under the Smugglers and Foreign Exchange Manipulators Act, the Benami Transaction Act, the PMLA, or the Black Money Act. Under any of these acts, if he has information in respect of the person and he has given this information, communicated this information to the taxpayer. Now, the problem which this created was that, okay, the tax authorities have information, but that information does not necessarily mean I have violated the law. For example, you have information, the tax authorities have information that, okay, I have purchased a couple of properties outside India, but they were from my disclosed sources and I have also disclosed them in my ITR. So I am not in violation of the Black Money Act anywhere. The disclosure is there, the sources are identified. In spite of that, the information is there. Simply having this information could debar the assessee from filing an updated return. And this was not the intention. So what they now say, if the new wording is, if the officer is in possession of information in respect of such person for the said tax year regarding violation of specified laws, and if the same has been communicated to him. So important is not, it's not just information, it is information about violation. So there must be more concrete information relating to the violation, then probably you are debarred from filing an updated return for that particular assessment year. With respect to the special audit, inventory valuation, there is a minor change, which is, 6 months has been changed to specific 180 days. And, these are just qualitative changes. I don't want to dwell upon this. But wherever there are good changes like this one, let us highlight. Under the old section 143.1, that is our summary assessment or what we call as intimation, the tax authorities were not granting us the rebate under section 89A. What was rebate under 89A? If I am a taxpayer and I was getting income from a retirement benefit account notified in a maintained in a notified country, then maybe there was some TDS on that particular income in that country, and I was entitled to the rebate under 89A for that particular taxpayer. But interestingly, as per the wording of 143.1, that rebate under 89A was not covered. And because of that, the issue would arise in all those cases that intimation would come with a demand, then you go for the rectification, or you had to go into appeal and then get the benefit of the rebate, and then the demand would be nullified. Now, fortunately, in the new section 271 subsection C, subclass C, clearly they have said all rebates under chapter 9 would be covered, which is also including our rebate under 89A, which is the new section 158. So again, this is a very, very good change. With respect to the dispute resolution panel, the old section 144C, the earlier provision said had in fact given detailed working that, okay, this is what the DRP should do, this is how they should do their work. Now, thankfully, what the new act is saying, they do not say that you make these inquiries or these specific verifications, but they simply say DRP should issue the directions stating the points of determination, the decision thereon, and the reason for the decision. This is to ensure greater transparency. So they say, okay, you do the work in the manner you feel fit, you are a senior authority, but what all are the points you have determined? What is the decision? And what is the reason for that decision? You have to clearly mention. So it should be basically a speaking order with reasons on all matters which were raised before them. With respect to reassessment, reassessment is now permissible in two more new cases. One, if any direction is given by the approving panel relating to an impermissible avoidance arrangement. So if the GAR panel gives a decision that a particular arrangement is an impermissible avoidance arrangement, then that would be a fit case for reassessment. Or if there is any finding or direction contained in an order passed by any authority in any proceeding under this act by way of appeal, reference, or revision, or by a court in any proceeding under any law. So order is passed in appeal, that could be a fit case for reassessment, right? Just small highlight that earlier the time limit for issuing the notice for reassessment was 3 years, 3 months. It is now increased to 4 years, 3 months. 5 years, 3 months has increased to 6 years, 3 months. At first glance, it appears 1 year extra tax authorities are getting. That is wrong. Earlier, it was 3 years, 3 months from end of assessment year. Now it is 4 years, 3 months from end of the tax year, which is the financial year. Actual effect is the same. There is no real increase or decrease in the time available to the department for initiating the reassessment. Important clarification has been given that the notice under 148A or 148, that is the show cause notice or the reassessment notice, cannot be issued within 1 year from end of any tax year. So from end of the tax year, one full financial year, they cannot initiate the reassessment. And the logic is simple, because you have 1 year from end of the tax year to file a revised return. Because now a revised return can be filed within 12 months. Earlier it was 31st December, now till 31st March, we can file a revised return. So that is why this change has come into force. Then with respect to order giving effect, old section 153.5, new section 286. Now, one of the very interesting or practical issues we were facing is assessment or reassessment happens. We go into appeal to the CIT, to the tribunal, and we get a order in appeal which is giving us relief. then to grant that relief, the original or the order giving effect had to be passed by the assessing officer. Now, originally, the time limit was given 3 months for the officer to pass this order giving effect, which could be extended by the principal commissioner or commissioner by another 6 months. Totally, 9 months were available. But within the 9 months, the problem was that in most cases, it was very difficult for the tax officer to complete the order giving effect within 3 months. So, invariably, in majority of the cases, they had to make an application to CIT for extension of the time limit. Now, what they have done is they have twisted the time period. The new act says the order giving effect should be passed within 6 months from the end of the month in which the order was received, passed by the commissioner. Okay. And can be extended by CIT by another 3 months. So the logic is, even now you will have 9 months, but original time period will be 6 months and the additional extended time limit will be 3 months. How does this impact the administration of the tax authorities? Here, it is now expected that the officer will invariably finish the order giving effect within 6 months. And in very rare cases, they will have to actually approach the commissioner. And the commissioner would also be very careful, because he will say that, okay, what were you doing for 6 months? You had a substantial period of time, and the officer would definitely try to ensure that he is not reprimanded by the senior officer, and he would try to ensure the work is done within the original period of 6 months itself. So we expect that hereafter the order giving effect will be passed definitely in a much faster time. Appeals to the income tax tribunal. As far as the tribunal appeals were concerned, earlier act mentioned a list of sections or orders against which we could file an appeal. So this created a loophole that, okay, when the act is amended, new sections are introduced, some sections could not be appealed against. New section 362 clearly says tribunal, you can go in appeal to tribunal against any order of the CIT appeal or the Joint Commissioner appeals. So this will ensure that you don't need to amend the act every year whenever new sections are introduced. With respect to the TDS and TCS provisions, as I said, the sections of TDS are grouped now into section 393, and they have made 4 tables, 3 tables telling us about the TDS, which are table A, TDS on payments to residents, table B, TDS on payments to non-residents, and table C, TDS on payments to any person, resident or non-resident, or that is both. So all the provisions relating to residential payments are covered in the first table. Non-resident related payments are covered in the second table, and payments which could be made to resident or non-resident are covered in the third table. And there is a fourth table in which all the exemptions are given, that on these type of payments, you need not do any TDS. So for example, for interest, on this type of payment of interest, there is no need to do TDS, or this type of payment of rent, you need not do TDS. All that is mentioned very clearly. Again, in the fourth table, I will call as table D, which is relating to all the exemptions. So reading the TDS law is now going to make sense, because the basic provision is one. Only in table, what you will see, the actual calculation mechanism. Okay, what is the threshold, what is the rate of TDS, and what is the nature of payment on which the tax is to be deducted. Similar consolidation is there for the TCS also. One loophole which has been plugged is that today we know that TDS is done at the time of payment or credit, whichever is earlier. In some of the provisions, it is mentioned that even if you have credited the amount to a suspense account, even then it is treated as a credit and TDS has to apply. But this specific provision was there in a few sections, not in all sections of TDS. Now, since you have one common section of TDS, this loophole is plugged. any type of payment you are making, even if it is credited to suspense account, TDS will apply. For lower deduction of TDS, earlier only against certain payments we could make the application. Now we can make the application under the new section for any type of TDS payments. 194 IB. 194 IB, the old section which dealt with the rent payment. And here we are talking of rent payment made by not a regular person who's doing TDS. That is, we are not talking of a person whose turnover has crossed 1 crore and all that. We are talking of a person who maybe has no business or has a business with turnover of less than 1 crore. And if he's paying rent, then if that rent was more than 50,000 per month, he was supposed to do the TDS. And that too once in a year, that is in the last month of the year. Right. That section continues, but the definition of rent has been expanded. Earlier definition of rent was rent for use of land or building or both. Now, the new definition is rent for use of land or building, building including factory building, or land appertinent to building including factory building. So that factory building concept has got added, which was not there earlier. A very welcome provision by the bankers. If I am withdrawing money from the bank, then the bank was supposed to do the TDS 194N, and there were differential rates, 2% and 5%. And there was a condition they had to check whether you have filed ITR, you have not filed ITR. All that is gone. They now say it is, we cannot expect the banker to check whether you, the taxpayer, have filed ITR, you have not filed ITR. They now say, okay, if you have withdrawn more than 1 crore, then whether you have filed ITR or not in earlier years, the rate of TDS will be 2%. So for the bankers, there is less effort required. They don't have to go outside their domain of banking. A very, very major impactful change. Earlier, any TDS, TCS we could file, we could correct it within 6 years from the end of the year in which the original statement was filed. 6 years from end of year in which it was filed. Now this is reduced to 2 years from end of the year in which original statement was due. Not original statement was filed, but original statement was due from end of that year, 2 years. So amendments to your TDS statements, now there is a very, very limited and a very specific finite period. So we need to ensure that the original filing itself is correct and there is no need for a correction statement. In our penalty provisions, at many places, we have the wording which is used without prejudice. So we have these sections 271A to 271K. In all these provisions, it is mentioned without prejudice to other provisions. Now, what that meant was that when a penalty is being levied under any of these provisions, this penalty without prejudice meant that I can levy this penalty in addition to other penalty also for the similar offense. So multiple penalties were clearly available. Now the word without prejudice has gone to simplify the language. So that now creates an ambiguity that, okay, for one offense, if there were two similar penalties under two different sections, can there be now that dual penalty like in the old act? In the absence of the word without prejudice, there could be now unnecessary litigation that, okay, only one penalty should apply for same offense, two penalties should not apply. That sort of a litigation can definitely unnecessarily start. Then coming to one small point in transfer pricing, old section 92A definition of associated enterprise was given in two parts, part 1 and part 2. Part 1 gave general conditions, part 2 gave the specific situations. A doubt was always there and a litigation was going on that if I don't satisfy one part, should I check the second part at all, or both have to be satisfied? Now what they have done in the new section 162, All the conditions, part 1 plus part 2, are merged into one single section, into one common criteria. So the dispute whether I should satisfy part 1 or 2 or both is no longer in existence. This is going to avoid all the unnecessary litigation. Then on charitable trust, as I said, I just want to highlight something very important, because charitable trust by itself is a huge discussion, and I don't want to enter into that territory because even 2 hours would not be sufficient to discuss this. But as I said, what is now happened is a new chapter is created, and that is the taxation relating to the non-profit organizations. So all the provisions which were scattered across the act have now been brought into one common location. So earlier chapter 3 was applicable. Now you have a separate chapter, chapter 17, which shall apply. And here, uh, just some terms which have been created which were not there earlier. As I said, I am not going into the detailed taxation otherwise also, but the point at least I want to bring to your notice the terms which are used which were not earlier used. The first term which is now coming to picture in addition to NPO, and that is regular income. We have the term regular income, we have the word residual income, we have also a word deemed accumulated income. So just quickly let us understand what do you mean by these three terms. Regular income will cover 5 types of incomes. Activity income, that is income from the activity for which the NPO was registered. Secondly, income from property, deposits or investments. Third, income from property, deposits, investments, partly held for charitable, partly for religious. Fourth, voluntary contributions, that is our donations. And fifth, permissible business income. Residual income is total income without giving the effect to provisions of this part. That is total income minus regular income minus specified income. What is specified income? Specified income is those incomes which are going to be taxed at the highest rate. That is what we call as the maximum marginal rate. These are incomes like anonymous donations or incomes which are taxable because you have violated some of the conditions relating to the non-profit organizations. That is, you are applying income for the benefit of related parties, you are using the income outside India, deposits or investments are made violating the conditions given in the schedules, or deemed corpus donation conditions are violated, there is a misuse of the accumulated income, or non-application of the accumulated income in time. So specified income, regular income, residual income. So my total income of the NPO minus specified minus regular will be called as residual income. There is one more term I would like to touch upon, and that is deemed accumulated income. As far as deemed accumulated income is concerned, this is a concept we are aware of, only it was never given a name. Original taxation of the charitable trust was that, okay, if I earn 100 rupees income, every year to ensure the exemption, I had to apply 85% of the income. I could apply more, but 15%, even if I did not apply that year, by default, that 15% concession was always there. I could apply it any time in future. There were no conditions that in so many years you should apply that remaining 15%. Many people commonly called it like a standard deduction, though it was not a standard deduction. So this 15% accumulation, which we are doing every year, is now given a specific terminology, deemed accumulated income. So it's not something new, but the name which has been granted to it, deemed accumulated income, is that 15% which we were earlier permitted to accumulate will also continue, but by this specific name. Commercial activities are permitted, but there are some restrictions thereon. Let me not go into those territories. But couple of important and impactful changes which have been made through the Finance Act 26 on the New Income Tax Act, I would like to highlight. First was with respect to the employee's contribution to Provident Fund under the various laws. We know that if the payment was not made under the due date of the respective act, it was a permanent disallowance. But in the new law, the due date has been defined to be due date under of filing ITR, So if the employee's contribution to the gratuity, PAF, ESI is made late, payment is made late, but before due date of ITR, you will get getting the benefit of the deduction. You will not suffer the disallowance. The certificate for nil or lower deduction of tax, the entire process is now being shifted online, which will make the life of the taxpayer very, very easy. Another very beautiful change in the new law, and that is the purchase of property from non-residents and the TDS thereon. Earlier, if I am buying a flat from a non-resident, I was required to obtain a TAN, file the TDS return, generate the TDS certificate and everything. But usually this is a one-time activity. So they said if you are a buyer who is a residential HUF, resident individual or HUF, you need not have a TAN. You can directly file a return cum chalan and you can buy the property from the non-resident without any issue. No need to obtain a TAN, no need to file a regular TDS return separately. Due dates of filing ITR have been changed substantially, particularly the one transfer pricing cases remain 30th November. The corporate entities or the partners in the firm where there is an audit or an audited firm, 31st October. Where there is no audit, but there is a business or profession, it is no longer 31st July, it is 31st August. And for everybody else, it is 31st of July. So majority of the workload will shift to August and to October, of course. Revised return, earlier we could file only by 31st December. Now we can go up to 12 months, that is by 31st March, we can file a revised return subject to, of course, some additional late fees. With respect to block period of another person, say during a search of X, information of Y is found, and now the block assessment of Y is to be done. Earlier, the block period of X and Y would also be the same. So if X is being assessed for a period of 6 years, Y would also be assessed for a period of 6 years. But if the information of Y now relates to only one particular year, then they say, okay, the block period for that other person, namely Y, can be reduced to that 1 year or 2 years as the case may be. For the search assessments, earlier the time limit was 12 months and it was from the end of the quarter in which the last authorization of search was executed. Now it is going to be 18 months, but 18 months to be counted from the end of the quarter in which search was not concluded but was initiated. So the commencement has changed so that from 12 we have gone to 18, but it will begin from end of the quarter, not when the search ended, but in which the search started. Most dangerous and very interesting. Earlier, we had a penalty under section 271B that if your audit is not happening in time, you would face a penalty. That penalty has now been converted into a fee, late fee. So if your tax audit is not completed in time and the delay is up to 1 month, there is a filing fee of 75,000. If the delay is more than 1 month, it is 1.5 lakh. Same way, if you do not get a transfer pricing report in time, no longer there is a penalty, there is a late filing fee, delay up to 1 month, 50,000, and beyond that, 1 lakh rupees. And the last change which I would really like to focus upon, and that is the tax on the unexplained cash credits, investments, expenditure, etc. Earlier, old act, the tax on this was at the rate of 60% plus 25% surcharge plus 4% cess. The basic tax rate was 78%. And in addition to that, there was a penalty of 10% of the income. Now, that 10% of the tax, so that effectively was 78 plus 6, which would give up to almost 84%. Now they say, okay, if there are unexplained cash credits, unexplained investments, unexplained expenditure, tax rate will be 30%, plus surcharge 25%, plus cess 4%. So effective rate is 39%. But you would now suffer a penalty for underreporting of income on account of misreporting, which will tantamount to 200% of the tax. Now that you can see is going to be a big blow, though it appears that the tax rate has gone down, the penalty has shot up, and effectively you will end up paying much more. But a very interesting concession has been given that if there is some unexplained money, cash credits, investment, expenditure, and you, the taxpayer, on your own declare it in your ITR, then there will be no penalty. Meaning you will only pay that 39% and you will buy peace of mind without paying the penalty. So that is a very good concession. Basically, the tax authorities seem to be in a frame of mind that, okay, you come clean, you have made a mistake, you rectified in your own ITR, clearly tell it to us and pay the tax. We are not going to penalize you for this since you have owned up. There are these retrospective amendments, and on all of these retrospective amendments, we are aware that the writ petitions have already been filed in the high courts, and probably so many high courts already, I am aware, 7 or 8 high courts, the writ petitions have already been filed. So these are matters which will, probably take some time to resolve. So I think with that, I should have completed with the content which I wanted to share. Now, Neha, if there are questions, we can take up the questions.
Yes, sir. There are a few questions which have come up.
Okay.
So I'll just go to them. Sir, one of the question is there any authority established to get aerial distance certified in case of immovable property, whether situated in specified distance from municipality under the new act?
No, there is no separate authority mentioned. Whatever was there earlier, same principle will have to follow. There is no change.
Okay. Uh, with respect to 44 AD, there are a couple of questions.
Okay.
One of the question is someone wanted a clarification on or confirmation that taxpayers not opting for section 44 AD are also not liable to tax audit irrespective of the fact of their net profit percentage being below 6 to 8% if their gross receipts or turnover is below threshold of 1 crore. Please confirm that whether this concept can be applied to 44 AD or A also.
44 AD, not A.
ADA also, similar can it be applied to this?
The query which is in
Sure.
front of me is having a different wording.
That is another, and there are two queries. Wait,
So
I will
see, the first
just.
question which is there is that, okay, that
Hmm.
currently some taxpayers have always been filing their ITR 3 and they have always been declaring their balance sheet and all their profit and loss account. They have never claimed the benefit of 4480 and they were showing their actual net profit, which was less than the 6 or 8%. That was
Hmm.
valid in the old law. Will that continue in the new law? The answer is yes, that will continue in the new law also.
Hmm.
There would be no change as far as that is concerned.
Okay. Are there any changes with respect to partners' remunerations, taxability?
Partners remuneration taxability has not changed. The partners remuneration taxability remains the same.
Okay.
Just like earlier it will be taxed under your head business profession, now also it will continue to be taxed under business profession.
Okay, someone has a practical problem is with regards to a trust which is registered under Societies Registration Act and has received professional registration under Section 12A and 80G. So the trust commenced operations and filed for final approval. This was rejected with the reasons that application is made under wrong code. Therefore, under the Income Tax Act 2025, under which subsection should they file for registration? Is what they are
That will
asking.
depend on the actual facts because for what is the purpose, what is the reason, the clauses are different. It will be very difficult for me to give offhand answer for this.
Okay.
It is a
Uh,
very specific case, so we'll have to identify the clause. It will take some time based on the documents.
okay. So the member who has asked is from your city. So maybe the member can
They can
directly
directly connect with me. There is no issue.
directly connect to you. Yes. Uh, And there is one more question regarding the proviso which made meal vouchers taxable for new regime is now not there in the new Income Tax Act.
Correct.
So now many are interpreting that meal vouchers are allowed in new regime, while there
Absolutely.
is still one set which is disagreeing.
No,
So,
I will go with this interpretation. See, I've read the income tax rules very clearly. The
hmm,
old income tax rule very clearly for the meal vouchers had mentioned that this benefit shall not be available for an assessee who is claiming the benefit under 115 BAC. That is missing in the new income tax rules. That point was specifically there. It is specifically missing. Now, if they have intentionally removed it, then definitely it has to be interpreted in only one way, that whether I'm in old regime or new regime, I will be entitled to the benefit of the meal vouchers. Definitely.
okay. Someone has asked about unexplained cash credit issue in assessment, then still 200% penalty. But I think you have already clarified, right? That
Yes.
if it is declared, there is no penalty in there,
Correct.
right?
Correct. Correct.
Okay. Okay. And there are a few appreciations also that it was a very wonderful and detailed session. And can they get the PPT is the question asked by many of them.
Yes,
So,
Ashwini, I mean, the technical team can share the PDF of the PPT. I don't have any issue with
Yes,
that.
yes, sir, yes, sir. I will say yes, sir.
okay. And one question is, sir, very specific. So if you allow, I will just paste the question in the chat. So if you can.
If land is purchased before the year 2000, not cultivated, is sold in financial year 26-27, can the capital gain tax be avoided if the proceed is invested partly in purchase of flat and balance in approved government bonds, and the newly purchased flat is held for more than 3 years? Is there any change in the new tax regime and the act? No, no problem at all. So I have old land, which is apparently not an agricultural land. The question is, can I buy a flat, claim 54F? Can I also invest in the government bonds and claim 54 EC? That is, I'm not referring to the new sections, but yes, subject to section numbers. Can I do this earlier? Yes, now also possible. There is no problem. No issue at all.
Okay. And this is the last question which we'll take up for the day, which I have pasted. But this is more regarding representation and not a question. But if you want to talk about this,
There is a highly
negative and
negative and demotivated deduction as per income tax, which was 80 GG, rent paid for non-salaried employee. There was a cap of 5,000. As compared with salaried assessee, this was never on par. I agree. That only thing I could say is that already in my personal opinion, 80 GG was an additional benefit, which in fact made it beneficial for the taxpayer who was not earning salaried income. See, I'm a salaried income, my CTCA say 20 lakh. Company never gave me extra HRA. All that it said, okay, out of your 20 lakh salary, 6 lakh rupees is HRA. And out of that, I was anyway going to stay in a rented house. I was getting the HRA exemption. Okay. So I was entitled to the benefit of that. But I was getting it from my income here. But as far as the individual is concerned, who is not a salaried employee, they were getting the similar deduction, but under 80 GG. On one point, I agree that yes, 80 GG had this very restrictive clause, and that is maximum 5,000 per month. That is 60,000. Whereas a person earning HRA, they could claim the benefit up to 5 lakh or 10 lakh or even 25 lakh, depending on how much was the HRA and what is the amount of rent. So to that extent, this is a representational issue. It is a perception issue. ICI, if they want, they can definitely put this matter to CBDT that this is unfair. If the intention of 80 GG was to put the salaried and non-salaried employee at par, you are not putting them at par, and therefore, can we do something? So that is for the direct tax committee to make a representation on this. Can be done.
Uh, and sir, one just question is regarding the circular. One of the member has also asked that the circulars which we used to refer earlier as a part of Income Tax Act 1961. So are they now included as a part of Income Tax Act 2025, or still we will be referring to the circulars or
We
notifications?
will now the interesting part here is until new circulars come, we will still continue as per the transitional provisions. Earlier circulars, to the extent applicable, will continue to apply, but from time to time they will start issuing the new circulars with the specific section numbers updated for the new act. But as for the time being, old circulars will continue to have apply as far as the content remains unchanged.
Okay. So I
But
would like to, yes,
circular
sir.
in any case cannot modify the wording of the new act in any case.
Correct.
Yeah.
So we can say that if this act has come post all these circulars, so ideally the effect means in substance it should have been captured somewhere or the other in the act. Should
See,
we?
you can currently I would say this is like your AR judgments which have a persuasive value and they are not binding. So like that I could say these circulars will have a persuasive value but not necessarily binding.
Okay, so maybe may at the litigation stage
And
for
I
argument.
was reading that government is thinking of issuing some master circular on the new income tax act and the new income tax rules. So let's hope something like that happens soon.
Okay. So that's all with the questions we had. And I would like to specifically thank you so much, CA Subocha sir. It was really a very comprehensive session which you have delivered here, and there is so much of an effort has gone in preparing these slides, which I could see like it was really a uh, big presentation, and I think you have covered most of the things which we could imagine, and we could rather have questions popping up. But still, I would also like to thank all the participants, and specifically a few names which I can take: Viraksha, Balaji Radhakrishnan, Jyoti Maheshwari, Poonam Zaveri, Hardik Sethia. All these people have asked the questions which may have clarified a few doubts which maybe we have missed, and then through their questions we could solve. So thank you so much to the speaker, to all the participants who have joined. Thank you to the direct tax committee for organizing such a wonderful seminar for us, and thank you to definitely the chairman of direct tax committee, CV Chittare sir, and the vice chairman Pankaj Shah sir, our central council members, for having this arranged for us. Thank you for the team DTC. So thank
Thank
you
you,
all.
ma'am. Thank you, sir.
Okay, thank you guys, and thank you the audience particularly for the patient hearing. Thank you.
Thank you.
Hello, tech.